All right, we're live. What's going on, my fellow wealth creators? Matty Ice here. Welcome to another podcast, another Millennial Wealth Creator podcast, part 2, with Mr. James Barber here. James Barber, welcome back, man.
Hey, appreciate it.
Yeah, man.
Good talk last time. What else can we educate people on today?
Right. That's kind of the goal. You know, I got really good feedback on the first conversation. There was obviously, some more things that I think were important to discuss, which is why we're doing a part 2. Really appreciate you being here. And today I figure a couple of the things that I wanted to discuss previously was infinite banking. I definitely want to cover that today. I wanted to talk a little bit more about like one of the big hard sells of IUL is the tax-free retirement income, and just get your thoughts about participating loans to create that retirement income, how you structure it, how you recommend doing it. I've seen some pretty crazy stuff out there. I'm sure there's a right way to do it, but like I mentioned before, I mean, the point of these conversations and just anytime I do content on IUL is to just make sure that people understand what they're getting involved with and that they're doing it correctly. So I'd really like to cover that. And then I got some good feedback on the first conversation and some suggestions for topics. I think what we could close out with, or just at some point, is get your framework on how you decide whether it's like whole life or IUL is best for somebody. Like, to walk us through the process of like start to finish when you meet with somebody. All right, what are the questions you ask, and what are the answers that you're looking for that indicate which direction you should go? I think that would be really good as well. So, but let's start with infinite banking. All right, I'm a huge fan. I absolutely love infinite banking. It's been a game changer in my life. It's one of the things that got me into the business or the industry, because I really wanted to share this awesome financial strategy with people. It's not right for everybody, but it can be very effective. Do you personally implement infinite banking? Are you a fan of that strategy or no?
I do. Infinite banking is why I started my channel as well.
Okay.
Basically, infinite banking got me into this space, the life insurance space, high cash value life insurance. Prior to that, when I got into this industry, I was doing annuities, working with educator market. And that was where I got introduced to it, a little bit in the IULs, but I had to do a lot of driving where I was going for training. And while I was driving, I'm YouTube University. I'm trying to learn as much as I can. And of course, infinite banking popped up, and all the videos that you would see at that time are like, they're all marketing stuff. It's like, it's talking about concepts, but like there was no details.
Right.
And so it's like, I brought up to whoever was it got me into the business. I'm like, have you heard about this thing? Like, it sounds pretty cool, but what am I missing? And they had no clue. They didn't know anything about it. And so I kept doing a deep dive and eventually connected with Steve Parisi at IBC Global, who at that time, he was working with outside agents, bringing outside agents in as he was growing his business. And I happened to be one of the lucky ones, got in early with him. He showed me how he designs policies, which happens, his whole philosophy in the policy design totally aligns with me, which is like, we don't care about commissions. We put the client's needs first. Whatever looks best, that's what we're designing. We can always do something different. If a client wants something different, we can do something different. But by default, we start with the absolute best design that we know of for the client, right? Without regard to anything else. It's got to meet their needs, and it's got to be the best design for the product that we're looking at. So his vision and the way he treats clients totally completely aligned with me, and it ended up being great. And I'm still connected with him for some of the whole life carriers that I represent.
Nice.
But he doesn't deal in IULs. I like IULs. I mean, I learned from him how he designs and does some of the whole life policies, and then I branched out and I learned more on my own, and I dove into the IUL space. And nobody teaches you how to do a good IUL. Like, nobody teaches you how to design the best IULs. And similar to in the whole life space, you can't use any solves from any of the carriers. Like, if you want to optimize a policy, there's no couple of quick buttons that you're going to
Right.
push to get the best
Right.
designs. You got to figure it out. And so I took the time and I figured it out.
Right.
And so that the infinite banking drew me into it. Let's get back to infinite banking. Infinite banking drew me into this. And from the beginning, you know, I got the book, listened to everything that I could up until probably just a month ago. You know, I was still like consuming any content that I could on it. Even though like I know my stuff, I know a lot about it, but I like to hear what everybody else talks about because we're never there, right? There's always something else we can learn.
Sure.
What am I missing that I don't know that
Mhm.
might be able to help out clients? So I'm always consuming content, and I got a couple of really big policies myself early on. I'm personally very aggressive when it comes to the infinite banking concept, and like I have this vision. I designed some policies that are meant to absorb a lot of cash, potentially in the short term, definitely in the long term. I opted for the very aggressive short term funding of those rather than stretching it out. I'm almost done with the max funding of those ones, but I've got other policies lined up in the wings that are waiting to absorb the extra cash that's
Right.
not going to be going to those policies anymore.
Yeah.
And from Nelson, we learned from the beginning infinite banking is just a concept, it's not a product. And
Right.
so, like,
I agree with that.
a lot of people get hung up on the product, and a lot
Mhm.
of agents, even the agents in the banking space that know that it's a concept, not a product, they heavily push a product with regard to what they think should be used for it. Whether it's you got to have direct recognition, or you got to have non-direct recognition, or it's got to be designed like Nelson would design it, which is like not a skinny design. You can't blend too much term. Can't be
Right.
reducing that commission too much, right? That's not good for the client, according to some folks. There's so much out there, and like realistically, the concept is product agnostic as well. There are all kinds of things that you can do with it. I mentioned this in the debate with Chris, but essentially you don't even need to own a product that costs you money, right? I mean, you can put money under your bed and call that your infinite bank, and you can pull money out when you need it. You could pay yourself back interest and slide it back under your bed, and that could be your infinite bank. But there's risks associated with it, right?
Well, and there's
The house
also
could
better
burn
ways to
down.
do it.
Oh, there's
Like,
definitely better
there's
ways to do it, but
because
just from the
like
risk standpoint is
sure, sure.
huge.
But at the end of the day, like you're right. Like there's a very big difference between it being a concept, like a strategy, versus the product. And I do think people get hung up on the product, but at the same time, I do think like if there is an ideal product to do it, because like I've seen people push infinite banking with like HELOCs or even credit cards and stuff like that. But it's like, well, I mean, I suppose you could do that, but why
I
would
haven't
you
heard
if
that one
there's a
yet.
yeah, it's well, I only heard one with the credit. I think they were mixing like velocity banking with it, but like I've definitely heard people talk about using HELOCs with it. But it's like, and you could use cash, but if you have this asset that is going to continue to grow, give you all these additional benefits while you use the money, why not do that? Like, because it's not just about paying yourself back with interest. I think that's a little bit
Right,
misleading when people talk about that too. Like you're not really paying yourself back with interest. You're paying interest to the life insurance company. We'll
right.
get to that in a minute. But there is an ideal product for the strategy, and I guess that's where there's a lot of conflict, I guess, around the infinite banking concept when it comes to whole life IUL. And I guess let me ask you this, and I did want to give a shout out to Steve as well. I've learned so much from Steve, man. So if you guys aren't following his channel, IBC Global, we'll link it down below. Really, really solid guy. I really like Steve. But let me ask you this. So you started going down this infinite banking journey. You were working with Steve. He does primarily whole life. He doesn't mess with IUL too much. At what point did you decide to start using IUL instead of whole life, and why? Like, what do you think the advantages of using IUL over whole life for the strategy is?
I don't use IUL instead of whole life. So this is where I would disagree with you that there's an ideal product for infinite banking. I think there's an
Okay.
ideal product for a particular client. There's an ideal product for a particular situation, and that may vary. So I currently own 13 policies, 14 policies. One of them is an old whole life policy that we owned on my wife that is like your normal traditional one, but it's so small I don't get rid of it. Essentially, when it comes to infinite banking, you're going to tap into, if you have a bunch of different lines of credit. In this case, I've got 13 different lines of credit that are available from 13 different policies, right? Doesn't matter what kind of policies they are, but it is a mix of whole life and IUL. But there could be VUL in there. I don't know what else there is, but essentially it could be any of those
VULs?
things. It's a life
Oof.
insurance product. Yeah, I'm not a huge fan, but
Oh man.
I'm just saying it could be that it is a life insurance product out there that you do have access to the cash value. So
Sure.
if you consider access to your cash value in a life insurance policy, whatever the policy is, it's a line of credit. It gets treated like a line of credit. It's not going to, it may affect the growth in the policy if you tap into a loan. Doesn't matter what the product is, right? But your infinite banking, if you're utilizing those lines of credit and not a bank, like you can consider all of those lines of credit as part of your infinite bank. It doesn't matter what the product is. So if I take my cash, because this is what I do, I have extra cash, it goes into my policies. So the first thing I do is I max out my policies, right? So I consider money that I have stored, it's in my policies, all of those policies. If I need money, I have to decide where to borrow it from. Am I going to borrow from a whole life policy because people say that's the best thing for infinite banking? What's the criteria that I'm going to use with what policy I'm going to decide to borrow from first? What would you use to decide which policy to borrow from first? I have a whole life policy, non-direct recognition with Mass Mutual, 5.82% right now. I have Guardian. I could borrow at 5.4 or 5.76%, but it's a direct recognition policy. It'll adjust my dividends from 6.1% current dividend rate. It'll go down. I'll get an offsetting credit of probably about 5.5%. Okay. I have IULs. I have an IUL with a carrier that my loan rate is 4.6%. Participating index loan doesn't affect my growth. I have an IUL that's 5%. Doesn't affect my growth. Participating index loan. Participating index loan works like a non-direct recognition whole life,
Right.
where it ignores that you take a loan out. So those are your four choices. What's your first choice to borrow from? 5.82 doesn't affect the growth in any of my policies. 5.76 affects the growth in that policy, brings it down from the current dividend rate. Or a 4.6 or a 5%, neither of which affect growth in the policy. So like if you didn't know what type of policies any of those were, what would be the first choice to borrow from?
Well, so it's a good question, but I think there's a little bit there's missing criteria in my opinion, like when you're asking that, because there's another consideration as well. I guess this is a good transition into one of the issues. It's not even really an issue. I guess one of the a potential risk. I don't really know what you would call it using IUL. But if I had a choice between whole life and IUL, I would. I don't own IUL. I do whole life, but the other criteria would be is the possibility of not getting interest credit on the IUL during that particular year when you're using the policy loan. So you might be able to get a lower interest rate on that policy loan if you borrow from the IUL, but then there's also the potential where you have a 0 year and you're not earning any interest to offset the interest credit versus the whole life policy. It's guaranteed to grow and you're going to get the dividend.
I think that's a concern that a lot of people like to bring up, but it's irrelevant in my opinion.
Why?
The reason it's irrelevant is because I need money to go do something with it. And I already own these policies. I'm not trying to decide right now what policy to buy. I already own these policies.
Okay.
And I already max fund them. The policies are going to do whatever they're going to do.
Mm-hmm.
My question is, what does it cost me to borrow? Where do you go to borrow money when you need money? It doesn't matter what the underlying thing is going to do. Because, like, I don't know if I take a loan from Mass Mutual, I don't know what the dividend rate is going to be next year. It's probably not going to change very much. Like, we know that, but I don't know what the rate's going to be. So if I take a 5.82% loan from Mass Mutual, I might get a little bit of arbitrage. I might not get arbitrage. They can raise that rate up to 8% because it's a non-direct recognition. I could be in the situation like a lot of people are with Lafayette Life right now, where they had a 5.25 dividend last year, and the loan rates were somewhere in that ballpark.
It's like
And then
5.5.
yeah, and then this year it's 5.75 dividend, but the loan rate is now up to 7%.
Right.
Like, that's a massive swing.
Yep.
I'm not a huge fan of policies like that can swing big. My Mass Mutual one is a very small policy, and I will not get a bigger policy like that because, me personally, I like to know what I'm paying for my debt. When I'm deciding to borrow money, I like to know what I'm paying to borrow that money. I don't like it to change a whole lot, if at all. I would prefer it to not change at all.
So you're not concerned at all if you borrow against the policy and you don't receive any interest credit to offset that interest cost?
Not
Because
in any given year.
that's
Not
what
in any given year.
that's what can happen with the IUL. And granted, like, you know, with Lafayette, the interest cost has gone up, but typically the dividends follow it as well, and you know it follows interest rates and stuff like that. But
So
I guess
let me give
the
you
thing is, well, real quick, let me finish the thought on what you brought up with the positive arbitrage, because that could be one reason to borrow against the IUL, but that shouldn't be the only reason, because you could still have a 0 year, and yeah, you're paying 7%, you're only getting a 5.75% dividend, but that's another issue I have with the whole infinite banking concept, is that we're not trying, at least in my opinion, we're not trying to get positive arbitrage between the loan and what we earn in the policy. We get the positive arbitrage by how we use the policy loan. For example, if I borrow at 7, but I lend it out at 14% plus a point, do I really care if it's 7%? No, not really, because that's where I'm making the positive arbitrage. And
so you always have to care what you're paying for interest, though, because
I agree.
alternatives.
I agree, but
you're
it's not the only determining factor, like which policy to borrow from, because you could earn 0% in the IUL also.
So
while you have the outstanding loan.
Correct. I mean, there's another factor there. I don't have to take a participating index loan from my IUL. I can take a wash loan, in which case I pay 2% and I get a credit of 2%.
But then you're defeating the purpose of the strategy, where you're supposed to be getting well, as part of the infinite banking concept, you're supposed to get the uninterrupted compound growth while you're using the money to build wealth like you normally would. But if you take a wash loan, now that money is no longer earning
I'm getting 2% growth on what I borrow.
It's a wash loan, though. You net it. You net it 0.
You're missing something here. When you take a loan right now from your Lafayette Life, you're netting a negative 1.25%.
Right. That's assuming I don't do anything with the loan. If I just borrow,
of course. But if I
just
borrow
for no reason, then yeah.
But if I borrow a wash loan, my net is 0.
Right, but that money is no longer participating in the index. So if the market roars and you hit your 10% cap, that the way I understand a wash loan, correct me if I'm wrong.
The cap doesn't matter in the wash loan. The cap doesn't matter.
Right, but now you're interrupting part of the growth of the policy itself. Is that not the case with a wash loan? Because that money is no longer earning the cap rate, like the index, because it's washed out.
If I do a wash loan, I'm not going to earn the index potential.
Right. That's interrupting the growth of the policy, which is part of the strategy.
But I'm going to earn the 2%. It's still going to grow and compound.
But you're not going to earn the 10% up to the cap.
Okay, so I think there's some confusion here. And I think the confusion here is that you're viewing what's happening inside the policy separate from the whole loan and what you're getting from the loan. Whatever you're investing in. Okay. And you can't separate all of that stuff. We can to an extent, because like the way I look at it, if I need to borrow money, I'm going to borrow the money to go do what I need to do. I'm just going to do it from wherever it costs me the least amount of money,
Sure.
or has the least impact on the growth in my policies. Okay. So in some of my IULs, I've gotten 18% return, followed by a 0% return, followed by a 1%, 1.5%, followed by another 18%.
Okay.
If I have loans borrowed out during that 4-year period, why do I care if I had a 0%,
Right.
zero return in the middle of that and a 1.5% when I got 18 on either side of it?
Okay. So that's a
So I'm
good
not
point.
concerned in any one given year on what it's going to return. In my mind, the policy is going to do what it's going to do. My focus is, where are my index options? Am I giving it the best opportunity to grow? Because that's what I want my IUL to do. And I focus on the participating index loans. However, there are some situations where if I hit my anniversary and we had a really high, let's say we're using one of my policies that's the growth is tied to the S&P 500 100%, because I have one of those. I have 3 of those. And the S&P was like all-time high and it's just dropped, or it's about to drop, or whatever the case may be. I don't think I'm going to make money in that this year. I could, instead of choosing to pay that 4.6% interest and getting what I expect to be a 0 return, I can choose to do the wash loan, where I
Okay.
pay 2% and I get a 2%. So I'm going to
Right.
get that 2% instead of a 0.
Okay. Right. No, and I get that. I think this is where we go back to, in the conversation where we were talking about earlier in the first part, where it comes down to risk tolerance, I guess, because everything you're saying makes sense. For me personally, I would not want to deal with any of that because at this point, like, so you're saying like you get 18% 1 year, then 0, then 1, then 18. To me, I don't want I don't want to have to worry about like what my policy is doing. I'd rather focus on what I'm using the policy loan for, the real estate investing, the private lending and stuff like that. And then I also don't want to have to worry about like picking indexes in like because at that point you're kind of timing the market. Like if you're anticipating a 0 year,
Can be,
okay,
yeah.
you could take the wash loan, but then what happens if the market roars instead? So now you're trying to time the market as well. And nothing wrong with that. Absolutely nothing wrong with that if that's what you want to do. But
Yeah.
for me, when it comes to infinite banking, this is just my own personal philosophy around it. I think maybe it's a little bit more traditional for the infinite banking concept. Is I don't want to have to worry about the banking part of my banking system. Like I know what my whole life policy is going to do. It's just, and I'm going to get the guaranteed growth dividend. Okay, I'm going to pay a little bit over my dividend on the policy loan, but I'm okay with that. I could also get a cash value line of credits as well. I think I actually just got a quote for that a couple months ago. It was like 6.25%. That could be a potential option to lower borrowing costs.
Yep.
But I think it's more than just the interest rate, though. It's do we have the possibility of a 0 year? And if that's not an issue for you, and you're willing to take that risk because you could potentially earn, like you said, 18%, that's
Yep.
fine. All right, but there's a lot more. There seems to be a lot more moving parts trying to implement something like infinite banking with IUL versus whole life. Is that a fair
Yeah.
is that a fair
I,
statement?
I don't I don't necessarily view it that way, just because I view all of my life insurance as my cash. It's my cash. So to me, it's not complicated. If I need money, I'm going to go get a loan from one of my policies because that's where I store my cash. I mean, it's
Mm-hmm.
as simple as that. It doesn't complicate it. When I have an anniversary, I max fund my policy. It doesn't matter if it's an IUL or a whole life. If I own cash value life insurance, the best thing to do is max fund it. You put as much money as the government will let you put in,
Yep.
because
Great.
if you fund it any lower than that, like you're already paying for the expenses. It
Mm-hmm.
doesn't matter if it's whole life or IUL or whatever. You're already paying for the expenses. When you throw in extra, almost all of it turns into cash. There's a little load fee, and that's it. And the rest of the life of the policy, it has the opportunity to grow and compound. And when I borrow, I'm going to borrow from wherever it makes the most sense. So like I separate those two things out, and I don't
Yeah.
generally dig into those weeds. People don't have to get into those weeds, but they can. I pay attention to the stock market basically every day. I don't think there's a single day that the market's open that I haven't looked at it and seen what's going on in it. So not everybody does that. Not everybody has a feeling on what the market might do. You don't have to get into this stuff to try to time the market. If in your mind you want exposure to the S&P 500 but not the downside, you can get that in an IUL. And you know that now that you own that IUL, your best thing to do is to max fund it and take advantage of when that S&P maxes out. And if you need to borrow against it because you want to practice infinite banking, you can do that. You have options between loan types. You can just choose whatever is the best for you, or you can choose the one that ignores whether anything is happening, right? That ignores that you have a loan. So there's options in there. To some people that's complicating, to others it's not complicated. It's just you
Yeah.
have
I
extra
don't.
options.
Yeah, I mean, I personally don't think it's like super complicated, but I think these things are important to understand when you're deciding which direction you want to go. Because I mean, traditionally speaking, infinite banking is done with whole life. And for a lot of people, it probably should, but that doesn't mean you absolutely have to do it. But if you are going to use an IUL, you do need to understand these moving parts and what can happen within the policy, and how it differs from whole life. So I guess that kind of that's a good segue into your framework on helping people decide which one is going to be best for them. But real quick, there's one other thing I wanted to ask you about with infinite banking, and I've watched a couple of your videos on this on policy design. Obviously, one of the big issues with IUL is probably not the ones that you design, at least based off what I've seen, but it's the surrender charge, the surrender period, right? Where, like I've seen some policies where they don't have access to very much cash value at all. Same could be said for whole life. I've seen whole life policies like that as well. But specifically with IUL, the surrender charges can be an issue. So what are your thoughts on the surrender charges, and what do you do specifically to make sure that a client is able to get access to a significant amount of cash value right off the bat?
When you design a whole life policy, what happens if you get a massive commission? Like if you were to design it with a big commission as opposed to a smaller commission, because we can decide where to dial that in for most of these products. So
Right.
like what happens to the cash value when you have a higher commission?
What happens to the cash value? It's lower. So the higher the commission, the
Yeah.
lower the cash value.
Yeah. I mean, it's the exact same thing in IUL. It's the exact same
But
thing.
how do you get rid
In
of the surrender charges though? Like,
You
because
don't
I
have
know
to
there's
get
like,
you don't have to get rid of the surrender charges, but with a proper design, with a company that allows us to do a blended design, just like when we do a whole life policy, a proper design, we're going to blend in some annual renewable term or a level term, whatever the product
right. So
determines is like the
you're
best.
adding a separate term policy onto the main policy. Well,
Correct.
well,
Well,
they're going to be,
it's a
it's going to
rider.
be the same,
It'll be a
right?
rider.
It's a rider. It's the same
Yeah.
policy, but you're adding term insurance. Yeah.
Same policy, but we're adding term insurance. And what happens? That term insurance doesn't pay anybody a commission, right?
Right.
And when we do that inside of a whole life, it reduces the agent commission and it increases the cash value that's available. And the greater you draw that commission down, or the base part of that whole life policy, and the more
Right.
we blend in the term, the greater the cash value that's going to be available. All the way
Right.
up to most policies, maybe 83% these days. There are some that we can still get up 90, 91,
Yeah.
93.
I had about 88% on mine on the first
Yeah,
one.
you can get really good. I mean, in 2021, a lot of the changes came in and reduced
Right.
what we could get out of that first year for some products, but there are still some that we can get really high. The it doesn't necessarily mean the most you can get is the best design, because even in whole life, like let's take Guardian for example, if you use their L95 and you put in the 5% load fee, you're going to have more cash value available in that first year than if you use the standard PUA, which is a 10% load fee.
Right.
But that 5% load fee comes at a long-term cost, and you'll
Right.
end up hurting your cash growth long-term in order to get access to a little bit more money right at the beginning.
Right.
Okay. Now, I view whole life and IUL as essentially the same types of products to the insurance companies. Like to the insurance companies, they don't care that much. They don't care which one you own. They treat them very similarly. When you pay your premium for a whole life product, you're not going to have access to 100% of the cash value, and the up to a point where we can affect it based on minimizing commissions. Once we get past that point, if there's levers that the company allows us to pull, it's going to come at a cost. That company's going to charge us
Right.
for access to more of that money. And
Right.
the same, so they don't call it surrender charges. You don't get to see the expenses in a whole life policy, but I guarantee you internally, they view that the similar way. You just never see it because you have access to a certain amount of cash. That's all you know when you buy a whole life policy is what's your access to the cash. Well, in the IUL, they have to reveal the expenses. They have to disclose these surrender charges. And so you get to see what's the value the policy is going to grow based on, and then what's the amount you actually have access to, which will be reduced by the surrender charges that might apply if you were to just cancel the policy. No carrier, whether it's whole life or IUL, is going to give you access to more of the cash than they need if you walk away with that policy.
Sure. Yeah.
So
It's
in
it's
the
give and take.
IUL
Like
space,
there's never any free lunch with life insurance. You know, a benefit you're getting on the front end. Normally, it's taking away a benefit on the back ends, right? That's just generally speaking
once we
how it
get
works.
past what the agent gives up, right? Because there's a lot the agent can give up to make policies designed better. And that doesn't come at a cost to the client. That's only a benefit to the client. And it's the same thing in the IUL space. Now, there are riders that you can completely do away with the surrender charge, but it's similar to like with Guardian, where you opt for the 5% load fee instead of 10%. It comes
Right.
at a cost.
So you get
Is
rid
it
of the
worth it?
surrender period. There's a cost to that,
Correct.
right? On
So,
in the long run.
so your actual cash value is going to be reduced because you paid for that rider that got rid of the surrender charges. Your cash value will be reduced. It'll be greater than what it was had the surrender charge been there, but it'll be reduced compared to the actual cash value that was in there. Now, there are some agents, they'll use those in order to kind of hide how they're designing the policy. Because like most people, if you do enough research, you kind of associate having access to more cash value as having a better designed policy, because that's the way a lot of the conversations take place, when that might not actually be the case.
Right. I agree.
I could charge a really high commission with the IUL and include that rider, which costs the client more money, but they won't see any surrender charges, and they'll see a lot of cash available in that first year.
So they
and
think it's good.
They might think they got a good policy, but they didn't.
Right.
I rarely ever. I think I've used that rider one time in the last 7 years, because when we reduce the commission, the surrender charge gets reduced massively as well. And so we can get 90% cash value in year one, even after the surrender charge.
How are you doing that?
Is
it just by adding that term insurance?
Yeah. And
That's
I mean, you need to have a good blend. So there's some products that don't allow any blend. There's some products that will allow a small blend, like 3-to-1. There's one that'll do a 4-to-1 blend. There's one that'll do a 5-to-1 blend. There's a 9-to-1 and a 10-to-1. My favorite product is the 10-to-1 blend. If you do that 10-to-1 blend and you're between 18 and 50, we're talking a $1.1 million death benefit, 100,000 base, million in supplemental term.
Okay.
Well,
so it's
for
similar
me,
to
that's an $80,000 premium. So if I fund that at $80,000, I'm going to have 90% plus of that available, because the surrender charge on that particular product is like $3,000. Like, it's very low.
Right.
Well, you don't get that if it's that same design and you're only buying $300,000 in death benefit because you only want to put in $8,000 a year. So you're not going to get a 90% cash value, because the surrender charge is still going to basically be the same as the policy that I did. Right.
So there's
a wide variability.
I got you. Is that 10-to-1 blend? Is that similar to like the difference in a whole life policy? That would be like the difference between the base and the paid up
Yeah,
additions. Pretty
absolutely.
close.
Yep.
Okay. How does that? Is that an issue at all? Since it's a term policy, it's a rider. Does that impact net amount at risk, cost of insurance whatsoever, or
Cost
is
of
that
insurance is
separate?
lower. Generally, the cost of insurance is lower. So the way that I view it, the supplemental term rider blends in annual renewable term, and the base policy itself is annual renewable term. There's no difference between those two annual renewable terms, except one of them pays a commission and one of them doesn't.
Hmm. Interesting.
That's the only way to think about it. Some
Okay.
of them give you the option to convert that supplemental term into base,
Right.
but there's no advantage to do that. It only costs the client extra money if they do that conversion. It's very weird. I don't even know why they give that option. But yeah,
Yeah.
there's no
So
benefit.
So it seems like three main things to pay attention to that I got from that is one, if you're going to try use an IUL for something like infinite banking, you definitely want to pay attention. You do want to pay attention to how much cash value you have in the first year. That is important. Two, you want to know if the surrender period has been eliminated or not, because that will add additional cost. Or if there has been additional term insurance added, meaning it still has a surrender period, right? But you have more cash value because you've added the term rider. Did I sum that up correctly?
Yeah, so the surrender charge is policy specific. It doesn't matter if you have a blend or not, right? But the surrender charge, because the commissions are based on that base amount, just like in whole life, the greater that base, the greater the surrender charge is going to be.
Okay,
Adding in a blended term doesn't affect the surrender charges. It doesn't affect the commissions.
gotcha. Okay, all right. I think that's a good like 30,000 foot overview of the design for something like infinite banking. Maybe we can do a separate training or whatnot. I'm sure you have plenty of training on your channel about like actually designing these things. I just want to get
Not
like a
really, but that's insurance companies they have proprietary design software. So like I share it with agents that I mentor,
yeah.
but
Okay.
we
Uh,
try to show. I do have one video where you can go in and you can look at an IUL that's designed with low cost upfront, low cost in let's say costs are managed in the end, and then you can see how that compares cash growth wise to high. I call them early, late, high, or high early, high late, low early, low late, low early. Uh, the opposite. There's four different
I
versions of
gotcha.
that, right? And you can see how it affects it. So like you can buy the worst possible design IUL, and if you manage it properly, like it could potentially work. However, like I deal with likelihood of success. When it comes to policy designs, what gives us the highest likelihood of success? In
Right.
general, it's the ones with the lowest possible expenses. So
Gotcha. Let's transition to the overall framework, of because like we've done some good back and forth here, like with whole life and IUL. Obviously, there's pros and cons to each, depending on risk tolerance and stuff like that. So we don't have to go into like the full process, obviously, but maybe walk us through your framework when you meet somebody, they're kind of on the fence about whole life and IUL. How do you help them decide which one is best for them? Do you have a series of questions you take them through? Walk us through that.
yeah, so a lot of people will come to me and they'll have a product in mind. And so I'll kind of start from there if they come to me with a preference. However, a lot of people come to you with with no preference, and we want to start with let's take a look at your whole financial picture.
Right.
So most people will have some type of an intake form or what would you call it? Just a a thing that you do, right? You just normally you go through the questions and you ask the questions and you get the answers that would otherwise be with a form. I used to use a form. I don't use a form. I haven't for years because I just kind of know what I need to know now.
Right.
And when I meet with somebody, I just ask them the
Sure.
questions. So
Sure.
what I want to know is what's your overall finances look like? That will tell me what kind of risks that they're currently in. I want to know what their goals are. And basically, like, between those two things, we get a good picture of what their risk tolerance is without actually having to say, what's your risk tolerance?
Sure.
Because
You
a
can
lot
see
of
what
people
they've
don't
already
know
done.
it. Yeah, a lot of people don't know the risk tolerance. They may think it's a lot higher than it is.
Mm.
And you can identify potentially a situation where it's actually not by looking at what they're doing. Also, like, what are we beyond your financial goals, which I want to know? What is, you came to me for this particular product, or for cash value life insurance? What do you expect it to do? Where do you see it fitting in your overall profile here so that it complements the rest of what you're doing? And so I like to ask that question. I don't always ask that question because sometimes I kind of get that going through the steps, but we get a really good feel for one or the other. When
Okay.
it comes to whole life, I like whole life as a savings alternative. It's super safe. If their finances tell me that they're taking a lot of risk somewhere else, whether it's risky investments, or I've had people come to me and they're like, in the beginning stages of this business, and like the success of that business is like the number one thing. Like, you getting a policy that might increase your net wealth by 5% a year compounding is not the biggest factor to your financial success in the near future. It's whether that business fails or succeeds,
Right.
right? Because you have so much put up into it. In that situation, I actually told them they need to wait. Like, don't add anything to the mix right now, because
Hmm.
you have not solidified that yet. But you get that up and running, and you start getting some regular income, and now we're not adding an expense. Because anytime we add a policy, even if there's a lot of cash value, we're adding an expense. You're paying for some insurance, and that could potentially be a risk to whatever you're currently doing. But if their profile says, hey, we've got a lot of risk, I'm probably going to say, hey, you might want to consider whole life. That's a good pairing for that, because you have all this risk over here. And if you get set up with this, like, you don't even have to think about it. You don't have to worry
Right.
about it. It's going to do what it's going to do. You won't lose any sleep over it. And you'll be able to access so much of this cash value whenever it's needed, blah, blah, blah. We'll walk through the use of the policy, right? And how it can help them. I get a lot of people that will come to me and they have some exposure to the stock market, could be significant exposure to the stock market, but they have a lot of wealth and they're comfortable with the stock market. They like the stock market, and they like the idea of just having less particular risk.
Okay.
S&P 500, people love the S&P 500. I mean, it's really great. A lot of people have gotten a lot of wealth out of the growth of the S&P 500 historically. Who knows what it's going to do in the future or in any given year, right? But there are some people that are made for that type of investing,
Sure.
where
They
they're
love it.
totally okay with that up and down.
Hmm.
Like, I'm not. I don't like the ups and downs of that. Like, I don't own the S&P 500
Yeah,
outside of
me
my
neither.
IULs. I like having exposure to it, and I get my exposure to it in the IULs. But I have
Gotcha.
some clients that have like a lot of exposure to it in the actual stock market, and they said, you know what, I want that downside protection with some of this, and so they move some money over into the IUL. They're not interested in a 4% return. Like, they've got millions of dollars. They're like still aggressive in
Mm.
growing that as fast as they could, and they're a believer in the stock market,
Right.
right? That makes a difference. If you got people that believe in the stock market because of
Sure.
their experience with it, they're comfortable with that, they lean towards the IUL. If you
Right.
get people that have had a terrible experience with the stock market, they've been in the market and it's been up and down, like, they love whole life.
Right.
They love
That's,
getting away from that.
I'm in that category, man. That's one of the reasons why I gravitated towards whole life. Because in my journey, I originally started researching IUL, almost bought it, but then I learned about whole life. Like, oh man, whole life is absolutely what I want to do, because I just tend to be more conservative with my money, and when I do take risk, it's very well thought out, planned, strategic. I try and lower risk as much as possible. And this is an interesting point too, because I actually do have. I just started putting some money into the market, but it's not directly like SPY, for example. It's not directly the S&P 500, but it's a high income ETF that focuses more on cash flow. And so I'm giving up some of that upside potential in the market, but I'm getting all of this cash flow in exchange. So in a situation like that, like the example you were talking about, where the person loves the stock market, um, or maybe they don't, but they're willing to give up some of the upside to eliminate the downside. It's kind of similar, right? That's why that conversation, like, I like diving into their financial situation to see where they're already exposed, because that gives you an idea of kind of what their risk tolerance is already, how they feel about the stock market and stuff like that. But I think, yeah, I guess maybe where a lot of agents go wrong is they don't do enough of a deep dive. They're not product agnostic, I guess, where like they're trying to fit everybody into this one product versus taking a more holistic approach to the
Oh yeah.
person's financial situation and actually figuring out what's best for them. Right?
Well, it's so much easier. It's so much easier for these agencies to bring people in to be salespeople and have them focus on a product.
Right.
When I
Right.
came in, I was doing annuities, and an annuity salesperson, like their goal is to find money and convert it into annuities.
Sure.
They're not taught like what's balance. What like we have annuities that are for growth and we have annuities that are for income, and you try to get as much money as you can into both of those because that means you're getting paid. And that means the people that
Right.
hired you are getting paid. Whereas like when I look at these things, and even now, I'm going to figure out like, is an annuity appropriate in relation to whatever else they're doing? Do we
Right.
have, if
Does it
they've
make
got
sense?
$600,000 in a retirement account, I'm not looking at how can I move that 600,000 into an annuity, which is how I was taught. I'm looking at it as like, what's your overall goal and what's a right amount to bring in, what
Sure.
gets needed for guaranteed income, and like, what are you comfortable with? So like I'm definitely getting into different conversations than I was from how I was trained.
Right.
And it's the
Where you're
same thing
no
on the,
longer focused on one specific product.
yeah.
You're
And
focused
you'll,
on the financial situation and the goals. Like what are their
yeah.
goals? What are you trying to accomplish? And then once you know that, now you can match them to or offer a specific product based off of what they're trying to accomplish. Because
Yeah.
some
And you'll
things are
get
better at
people like,
accomplishing those things than others.
yeah, you'll get people like new agents with Primerica, where they are going to sell term insurance and tell their people to invest the difference, but go invest it with Primerica,
Right.
right? That's what they're trained to do, and that's their recommendation for everything. You get people with WFG, and they're going to go out
Mm,
and try to sell an IUL every single time, and almost always it's Transamerica.
yep.
That is not the best IUL, in my opinion. There's a lot of downsides. Doesn't matter which IUL product they have. But like, I never sell it because it's not the best one out there. But that's what they sell. Why do they
Right.
sell that? Well, they get trips for it. And like, but the agent doesn't know any difference. It's a multi level marketing organization and they want to bring people in, sell to their friends and family, and then they'll probably flake away, but they'll bring in other people that will sell to their friends and family. Like,
Right.
that's their business model. And for
Yep.
them to be successful, they focus on one product, and like, you're going to go make that product fit whatever situation you hear
Right.
from the person across from you. And
Right.
same thing happens in the whole life space for a lot of people. If for captive agents, for sure, right? They only have one product, so they got to figure out how to make that product work.
Right.
So I
That's where
like the situation we're in as brokers, where we get to
I agree.
choose among all the products.
I agree. I think that's huge. It's funny you bring up the MLMs and like WFG, because I was actually going to ask you what your thoughts are about them. And for me, I just see it as like a massive amount of moral hazard. Like it really it can get people into a lot of trouble.
Yeah,
And like with these multi-level marketing companies, for example, I mean, even you're right, even captive agents, like this is something that, like, if you're considering, regardless of what you're considering, whole life, IUL, or really any other financial product, I think it is important to understand the position that the person you're working with is in. And I'll give you an example. Like for me, I'm not going to set up an IUL for somebody. It's just not my thing. with that said, just because, I focus on whole life doesn't mean I'm going to try and shove whole life down everybody's throat. Like if I'm having a conversation with somebody and they are leaning more towards an IUL, I'm going to recommend them to somebody. Like, I'm going to express my concern about it. Like, here's how it works, but do your research. I'm going to introduce you to somebody, whatever, right? But when you have people that like the focus is solely on making money, it's just sales. Like these multi-level marketing companies, I don't care which one it is, PHP, GFI, WFG, whatever. They kind of all operate very similar. Family First Life, they all operate very similar. Where you get these agents that join because they're promised the world. They're going to make all this money, and they're just given sales presentations. They're just given talking points by their upline, like, hey, say this, this, and this in order to sell this product. You're assuming that it's just a good product because, well, they wouldn't sell a bad product, would they? No, they would never do that. They're full of all that. They said they have all this integrity and they're a Christian organization or whatever, right? Whatever they throw out there to make it seem like they're legit. But that's where people get in trouble, is when you don't understand how these things work and they're trying to fit everybody into this one box. Like, how do you know the IUL you're selling to somebody in that organization is actually good for them? It's
Well,
probably not.
every week when they do their trainings, those trainings are actually hype fests. There's
Right.
like, this person made this much money. This person made
Right.
this much money.
Right.
Go out and sell. You're going to do this.
Do you
And they
find
don't
that
get to learn about the products, actually.
right? So what my understanding is, there's very, very little product knowledge or an emphasis on product knowledge whatsoever, which is like just mind-boggling to me when we're talking about major long-term financial decisions here. Are you kidding me?
Yep.
The emphasis is on recruiting and making sales and going, winning these trips. Like, we're talking about people's money here and retirement. Like, you're showing these people all this amazing growth, all of this tax-free retirement income, when you have no freaking clue what you're doing with this thing. And
Right.
people are making decisions based off of what you're selling them. And when that doesn't play out because the product sucks or wasn't designed right or whatever, like, you're putting people in a very precarious position, and that's where the moral hazard really starts to come into play. So I'm glad you brought that up, because I was going to ask you about that. Do you find, in your experience, is that where a lot of the bad policy designs come from? Is it from these like MLM companies in your experience?
Yeah, I mean, I do see quite a bit that comes from that. A lot of that we'll never see because they're just selling to friends and family. These are people that probably would have never bought a product anyways, because they're not out looking for it, right?
Yeah.
And
Yeah.
the people that come to me find me through YouTube. However, there are a lot of YouTube people that do not do good designs. They'll
Right.
walk you through maybe the first step of how to optimize a policy and then make it sound like that's it.
Right.
Like, I just made it so much better than this bad design over here. But there's like two more steps that could
Right.
drastically reduce
Still
the
doesn't mean
amount
it's
of
great.
cost inside of a policy. Yeah.
Right.
So like they know how to do the first step, or they should know about multiple ones, but they only do the first one because otherwise it impacts the commissions too much. Now, I don't worry too much about that. Like, the way I view commissions and things, like, people have different business models. And if you can provide enough value that your clients are okay paying the higher commissions, then go for it, right? I kind of get uncomfortable when people are told that they're getting something that they're not getting, and the goal is
Right.
a higher commission for the agent. That's where I tend to have the problem. Because for some people, like, not everybody can sell the policies I sell. You get people that might sell one or two policies a month. They're not going to be able to cut their commission down to $300 or $1,000 because they're not going to be able to survive. And like, I get that. Not everybody is able to do that, but you should be able to justify it, right?
Right.
At least your
100%.
client will know, hey, look, I mean, you don't have to necessarily walk them through like, this is the best design, but I'm not going to sell you that. But you got to educate your clients, and even the clients that are out there and the ones that'll come across this. Just because an agent is charging you more doesn't necessarily mean that that's a bad agent to work with. They might be able to provide you with something that somebody else can't.
Right.
Um,
Yeah. The
just take
idea
that
that
into
there's
consideration.
commissions paid isn't necessarily a bad thing. Uh,
Right.
but you do have to be careful because the incentives are misaligned. The
Right.
way that the industry works is the less efficient the policy, typically the more commission the agent's going to get. So it's not the commission itself. And in some cases, like with whole life, sometimes the base premium needs to be higher, or sometimes it makes sense for the base premium to be higher. Especially if you're doing like a front load in the first year, you can get access to the majority of your cash value while having a higher base premium. So you're going to have more death benefit, you have more long-term care benefits, the type of deal. You maybe have a bigger dividend later on. Like there's benefits to doing it, but it comes down to what the person is trying to accomplish and designing it correctly based off of that. So it's
Yep.
not the commissions necessarily, but it's just all the more reason why you need to pay a little bit more attention to what's happening with this like the policy design itself. Because if you don't know what to look for, if you don't know what questions to ask, you could be working with somebody that has a little bit more focus on their commission and less on the efficiency of your policy. So it's
Right.
just something to be aware of, guys.
I
So
did. I had somebody the other day that they came in as a premium finance case. Premium finance, some whole life gets done with premium finance, but for the most part, it's an IUL thing, right? Have you come across any premium finance cases?
not personally, I've seen content about it, but I
Okay.
haven't personally dealt with it.
So you're basically buying or you're getting a loan from a bank in order to finance a policy.
Right.
And
Right.
the idea is you're dealing with wealthy people and they've got their assets tied up and they don't want to liquidate those assets to buy a policy. So they're going to get a loan
Right.
to do it. And insurance companies are okay with this because they understand the money's there. It's just tied up and they're okay approving that. So this person came to me with a design. It was a $25 million death benefit.
Oof.
The commission on that policy that they got designed was over $600,000.
Man,
Massive commission.
good payday.
I was like, yeah, massive payday for that agent. I was like, let me show you something. I did the exact same design, but I optimize it, and the commission for me would be $57,000.
That's wild, man. Oh man.
Same thing. He ends up saving over 15 years, $1.5 million in expenses.
Yeah. That's
because
crazy.
I took that cut on the commission. Like just amazing. But those are the kind of things that we're looking for, right?
Sure.
I would hate to see somebody get into a premium finance case like that where they might be paying 6-7% interest, and that rate can vary, right? It's not set. And they're paying out these massive fees, and they got pitched this really rosy scenario where everything is going to work out great, and he's going to end up with tons of money and income. Which you wanted to talk income. I have a few more minutes. We can talk income before we wrap this up. But that's what premium finance gets sold for. Is usually they're going to demonstrate some type of income in retirement.
Right.
So
right. Yeah, and with premium finance, I mean, you got to be careful with that too. Like, there's a certain like level of net worth that you're supposed to have because whenever you're introducing leverage into something, you're taking on more risk. You're adding more risk to the equation. You should get more reward because of it, but you need to be able to weather the ups and downs potentially. And like I saw, what was that company called? Kaizen, I think it was. Are you familiar with?
yeah, they're as little as 100,000 in
Right.
net worth. So I mean, they
Right.
don't require very much for their particular thing, but it has to do with why their product or how their thing is designed. Like they do a 50-50 type of premium finance where you're contributing half. So their risk is basically nothing. But there are companies out there that will give you 90% or even 100%, but you got to put up collateral.
Right. So. Gotcha. Well, it's crazy how time flies, man. My concern with going into the income part is not being able to have not being able to break it down as much as we probably should.
We can do a part 3 that focuses on income, and that might be good because you might have people that only want to see that. Like it's good to have videos that are like content specific.
Yeah, I agree. So I think if you guys want to see a part 3 for that, drop it down below in the comments. I think, yeah, I think it'd be better if we just did another segment on that.
Sure.
But I think we covered some really good stuff here, man. I really appreciate the conversation. I think this brings just a lot of clarity for people, you know, because there's a lot of noise in the industry about these two specific products. And, you know, I started off in my journey pretty aggressive against IUL because I was pissed off. I was like, I felt like I was almost duped, right?
Sure.
But as I've done more research and you know, it still doesn't fit my risk profile, but I've started to calm down on it a little bit more and just be like, look, as long as you understand how it works, you work with the right person and stuff like that, there's nothing necessary. There's nothing wrong with it. All right.
Well, you almost
My
were, dude.
issue,
It wasn't a good design for you, right?
well, it doesn't fit my risk profile, man. Like
I know that. I know that, but you're the one that they were trying to sell you. They didn't optimize it
oh,
either,
probably
did
not.
they?
No.
I can almost assure you that it was not optimized.
Yeah, not is probably not even close. And he was showing me like 12% distributions and tax-free retirement income and stuff like that. I was like, dude, there's so many red flags on this thing. Like, I can't do this, man. And yeah, it's not my thing. But it doesn't mean it's necessarily a bad product. It needs to be done in a very specific way. And my
Absolutely.
issue is that I think a lot of people are being duped because of the moral hazard, because of the misalignment in incentives, and it just pains me to see, man. It really sucks. I hate seeing people lose their hard-earned, like put their hard-earned money into something that is not in alignment with what they thought it was, and what they were trying to accomplish, and that's what really pisses me off. So I've kind of calmed down a little bit on it more recently, but you know, I think like if I saw stuff like this, you know, it probably would have gone a lot smoother, right? Like I would have gotten the information, like hearing both sides of the story. I just think that's really, really powerful. So I really appreciate you doing this. I'm looking forward to the next one if you're open to it, because I think people are going to find a lot of value in this stuff. So we'll go ahead and wrap up with that. Was there anything that you wanted to finish off with?
No, good stuff. Appreciate the
Good.
conversation. I love talking about this because a lot of agents, just like I was, are searching for answers. They're
Hmm.
just getting into the industry. And I'll tell you, almost every single agent that I meet comes into this with good intentions.
Oh, of course.
They want to sell their friends and family the best design policies.
Sure.
They just have no clue that they're not doing good. They're not selling them good stuff. And it's
Right.
usually too late before they find out. So,
Right. A lot of people getting in are very well intentioned. They want to do the right thing, and they truly believe they are.
yep.
And a lot of that is on the life insurance company, the organization that they're with. A lot of that is. But at the end of the day, you still have to take accountability, make sure you're doing your research so you're doing the right thing by people. And it starts with stuff like this. So
Yep.
awesome, man. Well, I appreciate it. And yeah, we'll get part 3 scheduled at some point. We'll start talking about that good old tax-free retirement income, that big promise of IUL. We'll break it down and have some fun. So, but until then, appreciate it, and we'll talk to you soon.
Sounds good.
All right, man.